When a war starts, everyone watches. When it ends, expires. Almost everyone gets it wrong. And that is exactly where the money moves. Here is what history shows. After major wars, stocks go up 73% of the time. Not down, up. After the Gulf War ended in 1991, plus 20% over the following year. After the initial shock of September 11th, plus 15% within 12 months. Across 40 major geopolitical events, across 85 years, positive returns 73% of the time. And yet, most investors still get it wrong when the war ends. The pattern is not random. When a war ends, specific sectors crash, different sectors quietly run, and the rotation happens faster than most investors expect. This is the sequel to the Iran crisis breakdown. If you have not seen that one, the link is in the description. Same framework, different direction. 3 sectors that historically fall when peace arrives. 3 sectors that historically run. And the one number that tells you when the rotation has already started before the headlines confirm it. Let's go. First, understand the asymmetry. When a war starts, fear drives the market. When a war ends, math drives the market. Here is the logic. War creates a specific set of economic conditions. Oil supply disruption, defense spending acceleration, travel restriction, risk-off positioning. Every one of those conditions has a corresponding winner. Energy, defense contractors, gold, cash. When peace arrives, those conditions reverse. Oil supply comes back online. Defense budgets face political scrutiny. Travel resumes. Risk-on positioning returns. The winners of the war become the laggards of the peace. The laggards of the war become the winners of the peace. That same 73% pattern applies here. 73% of the time, the sectors that underperform during conflict historically outperform in the 6 months after it ends. This is not speculation. The data from 20 major post-World War II military conflicts shows that in 19 out of 20 cases, markets returned to pre-conflict levels within an average of 28 days. Carson Group compiled an even broader analysis, 40 major geopolitical events across 85 years, from World War II to the Iran attacks of 2024. The result, the S&P 500 lost an average of only 0.9% in the first month after a geopolitical event and rose an average of 3.4% across the 6 months following. As Ryan Dietrich, chief market strategist at Carson Group, said directly historically, what in the near term seems like a geopolitical crisis tends to be largely resolved from a market perspective over the ensuing 6 months. Because the broader market recovering does not tell you which sectors run and which sectors give back their gains. That is what this video is about. 3 sectors that historically give back gains fastest when conflict resolves. Number 1, energy. This is the most immediate reversal. Oil spiked 8% in one day. Jet fuel surged 55% in a single week. Then Brent fell 6.8% in a single session when Iran's response turned out more symbolic than destructive in June 2025. That is not volatility. That is a reversal. And a confirmed ceasefire could make that 6.8% look small. ExxonMobil hit its all-time high of $159.60 on March 2, 2026, the day after the conflict started. Since then, every time ceasefire speculation surfaced, the stock pulled back. The war premium is not a stable position. It is a coiled spring. ExxonMobil, ConocoPhillips, Occidental all ran during the conflict. All face the same reversal risk when the conflict ends. The energy trade doesn't unwind slowly. It snaps. The energy trade is not a buy and hold position. It is a conflict premium trade, and conflict premiums expire. Number 2, defense. This one is more complicated and more interesting. Defense stocks ran for a reason that does not disappear overnight. Northrop Grumman up 6% on day 1 of the conflict. RTX up 4.7%. Lockheed Martin up 3.4%. Those gains were driven by 3 things. Weapons being depleted that need replacing. Defense budgets being accelerated. Long-cycle government contracts being awarded. None of those reverse instantly when a ceasefire is announced. But here is what does reverse. The speculative war premium, the part of the stock price that reflects investor excitement about an active conflict that comes out fast. After the initial spike in the first week of the Iran conflict, some of those gains moderated as the conflict entered its 3rd week. The pattern across conflicts is consistent. Defense stocks run sharply when conflict escalates. They moderate when conflict stabilizes. They give back the speculative premium, not the fundamental gains when conflict ends. To be specific, RTX has risen 110% from March 2023 to March 2026. Northrop Grumman up 60% over the same period. Lockheed Martin up 37%. General Dynamics up 57%. Those are three-year fundamental gains built on structural defense budget growth. That does not disappear when the Iran conflict ends. What disappears is the extra 6% that Northrop added in a single day when the bombs dropped. The speculative premium on top of the fundamental gain. That part snaps back. The underlying business, Northrop's $96 billion record backlog, RTX's Tomahawk replenishment cycle, Lockheed's THAAD contracts that stays, the excitement premium that goes. Number 3, gold and safe haven assets. Gold is the purest expression of the fear trade. When geopolitical risk rises, money flows into gold as a store of value. When geopolitical risk falls, that same money flows back out into risk assets. The same pattern applies to the US dollar in certain conditions, to short-term treasuries, and to volatility-linked positions. Peace is bad for fear assets. That is not a complicated thesis. It is just the arithmetic of what fear-based demand looks like when the fear goes away. 3 sectors that historically perform best in the period following conflict resolution. Number 1, airlines and travel. This is the most direct reversal of the wartime loser. American Airlines down 27%. Delta down 22%. United down 12%. A group of 29 leading airlines and travel companies lost a combined $22.6 billion in market value in the first week alone. But here is the reversal that is already happening before the war has even ended. On March 17th, Delta and American Airlines both raised their first quarter revenue forecasts at the J.P. Morgan Industrials Conference. Delta jumped 5% that day. American jumped 4%. The market is already pricing in peace before peace has arrived. And 18 analysts covering Delta have an average 12-month price target of $77.83, implying roughly 23% upside from current levels. That same 73% pattern is showing up here too. The sector that got crushed hardest is already starting to recover before a single ceasefire announcement. When peace arrives, the reversal could accelerate. Oil prices fall, jet fuel costs drop, Middle Eastern airspace reopens, business and leisure travel resumes. Consumer confidence recovers. The same double exposure that crushed airlines during the conflict, costs up and demand down simultaneously, becomes a double tailwind when peace arrives. Costs drop, demand recovers, both at once. After the Gulf War ended in 1991, airlines were among the first sectors to recover sharply as oil prices normalized and travel demand surged back. Number 2, technology and artificial intelligence. During the Iran conflict, tech stocks came under pressure. Nvidia generated $215.9 billion in fiscal year 2026, a 65% year-over-year revenue increase. And the stock is still sitting 11% below its all-time high. Revenue up 65%. Stock down 11% from peak. That is the disconnect. That disconnect does not exist because Nvidia's business got worse. It exists because geopolitical risk pushed investors out of growth assets and into energy and defense. When that risk fades, the disconnect closes. expires analysis captured the dynamic precisely. Technology stocks got caught in the selling as investors reduced risk and locked in profits. But the long-term demand story for AI is intact. Businesses are not going to stop investing in automation and machine learning just because there is a war. When geopolitical tension eases, that rotation reverses. The money that left tech for the safety of energy and defense has to go somewhere when energy and defense start giving back their premiums. It goes back to where the long-term earnings growth story is. And right now, that story is AI infrastructure. According to Grandview Research, the global AI market is projected to expand at a 30.6% compound annual growth rate from 2026 to 2033. Nvidia's $1 trillion demand pipeline through 2027 does not change based on whether Hormuz is open or closed. What changes is whether investors are willing to pay full price for that story when geopolitical risk is elevated. When risk falls, they are. And 57 Wall Street analysts currently have Nvidia rated as a buy, with consensus price targets well above where the stock is trading today. Number 3, consumer discretionary and infrastructure. This is the sleeper category. When a war ends, 2 things happen simultaneously. Consumer confidence recovers. People who were holding back on major purchases, cars, appliances, travel, home renovation start spending again, and infrastructure spending begins. Light Finance's analysis of post-conflict historical patterns is consistent when war ends. Shares of infrastructure companies that construct bridges, roads, and buildings can appreciate significantly. This makes intuitive sense. After every major modern conflict, there is a reconstruction phase. Supply chains normalize. Capital that was hoarded during the uncertainty period gets deployed. After World War II, the Dow Jones experienced a robust rally reflecting the post-war economic boom. After the Gulf War, the S&P 500 rose roughly 20% in the following year as economic activity normalized. After the post-9/11 shock, markets recovered within months and gained roughly 15% over the following year. The consumer and infrastructure recovery is not as fast as the airline trade, but it is more durable. Here is the practical part. Most investors wait for headlines. That is already too late. The market moves first, and it leaves clues. You do not need to wait for a formal ceasefire announcement to start positioning for the post-war rotation. The market will tell you when it has started. The number is Brent crude direction, not the level, the direction. If oil starts pulling back from current elevated levels without a clear macro catalyst, something is moving toward resolution behind the scenes. Smart money repositions before official announcements. When Brent starts a sustained move lower, the war premium is beginning to expire. That is your early signal. The second signal is airline stock direction. Airlines are the most sensitive barometer of conflict resolution expectations in this particular situation. When airlines start recovering before any official announcement, the market is pricing in resolution. Watch those two numbers together. Brent crude moving lower, airlines moving higher. That combination before any headline is the market telling you the rotation has already started. The pattern is real, but it is not guaranteed. Risk 1. The war premium does not fully unwind fast. If the conflict ends but Iranian oil infrastructure remains damaged, supply does not immediately recover. Oil stays elevated longer than expected. The energy trade extends. The airline trade lags. Risk 2. Defense stays stronger than expected. Geopolitical risk does not disappear when one conflict ends. If the Iran conflict ends but regional tensions remain elevated, defense budgets stay high. The fundamental case for defense contractors remains intact even as the speculative premium fades. Risk 3. The macro environment overwhelms the sector rotation. If the conflict ended today, but the Federal Reserve raised rates, that macro headwind would delay the tech and consumer recovery, even if the geopolitical premium was gone. The sector rotation logic is clear, but sector rotation does not happen in a vacuum. The broader macro environment always matters. Here is the one-sentence summary. Wars end, and when they do, the sectors that won during the conflict give back their premiums, and the sectors that lost during the conflict quietly recover. Energy runs during war. Airlines run when war ends. Defense runs during war. Tech runs when war ends. Gold runs during war. Consumer and infrastructure run when war ends. Same pattern. Different direction. Historically, every single time. 73% of the time, the market moves in the opposite direction to where most investors are positioned, not toward more fear, away from it. The investors who understand both sides of this rotation, the war trade and the peace trade, are never caught flat-footed, because the same framework that told you to watch ExxonMobil when the conflict started tells you to watch Brent crude direction when you want to know if the conflict is ending. That is the framework. Same pattern. Different crisis, same outcome. If this breakdown was useful, hit like. It genuinely helps the channel. Drop any topics you want covered next in the comments. I read them all. Subscribe and hit the bell. The next video covers the single number that tells you whether the oil premium from this conflict is fully priced in or whether there is more to come. You don't want to miss that one. See you every Mars. This is historical data analysis and market commentary only, not a buy or sell recommendation. All investment decisions are your own responsibility.